Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. The Nasdaq 100 Index tracks 100 of the largest non-financial companies listed on the Nasdaq stock market. It's a key benchmark for tech and growth stocks, reflecting innovation and market leadership. Over time, this index has grown significantly in importance for investors. An exchange-traded fund, ETF, is an investment fund traded on stock exchanges, much like stocks. A Nasdaq 100 ETF, such as QQQ, lets you invest in all 100 companies within the index through a single purchase. It's an easy way to gain broad exposure to these influential companies without buying each stock individually. QQQ has become a popular choice for many investors. Its appeal comes from its focus on well-known, high-growth companies. This ETF offers a straightforward path to participate in the performance of the Nasdaq 100. What is the Nasdaq 100 Index? The Nasdaq 100 Index represents some of the most innovative companies in the world. It is a modified market capitalization weighted index. This means that larger companies have a greater impact on the index's performance. When you invest in a Nasdaq 100 ETF like QQQ, you are tracking this specific index. Focus on non-financial companies. What sets the Nasdaq 100 apart is its clear focus. It includes 100 of the largest non-financial companies listed on the Nasdaq stock market. This specific rule means you won't find banks, insurance companies, or other traditional financial institutions in this index. This concentration helps the Nasdaq 100 reflect trends in other sectors more purely. Many investors find this appealing because it offers distinct exposure. For instance, if you already have investments in financial stocks, the Nasdaq 100 can help diversify your portfolio into other areas. This distinction is a key characteristic that defines the index. Predominantly technology companies. While the Nasdaq 100 isn't only technology stocks, most of its weight comes from them. Think of the big names in software, hardware, and internet services. Many are part of this index. Here are some of the dominant sectors. Technology, software development, semiconductor manufacturing, and internet services. Retail, non-financial. Large e-commerce platforms and consumer goods companies. Biotechnology, healthcare. Companies focused on medical innovation and pharmaceuticals. Industrial. Some industrial companies that do not fall under the financial umbrella. This strong tilt towards tech often means the Nasdaq 100 can be more volatile than broader market indexes. However, it also offers potential for greater growth, given the innovative nature of these companies. Market cap weighting methodology. The Nasdaq 100 uses a market capitalization weighting system with some adjustments. In simple terms, companies with higher market values, stock price multiplied by outstanding shares, have a larger slice of the index. This means a move in a huge company's stock price will impact the index more than a move in a smaller company's price. This weighting method ensures that the index heavily reflects the performance of its largest constituents. For example, if Apple or Microsoft, which are massive companies within the index, have a strong quarter, their performance will significantly boost the overall index. Conversely, if these giants face headwinds, the index can feel a larger impact. This structure connects the index's performance directly to the success of its biggest players. Key characteristics and benefits of investing in a Nasdaq 100 ETF. Investing in an ETF that tracks the Nasdaq 100 offers several compelling advantages for those looking to tap into the growth potential of innovative companies. From spreading out your investments to keeping costs low, these funds provide a straightforward way to participate in leading market trends. Diversification within the Nasdaq 100. While you might think the Nasdaq 100 is all about tech, it actually offers a surprising amount of diversification across various sectors. Yes, technology companies make up a large portion, but the index also includes major players in consumer services, healthcare, and industrials. This means you're investing in a basket of 100 large-cap growth companies, reducing your reliance on any single stock. Consider these sectors represented within the Nasdaq 100. Communication services. Think of global media and entertainment giants. Consumer discretionary. Large e-commerce platforms and retail innovators are here. Healthcare. Biotechnology and pharmaceutical companies focused on research and development. Industrials. Select non-financial industrial companies that fit the index criteria. This mix helps smooth out some of the volatility you might expect from a purely tech-focused investment. It provides exposure to different industries that are all pushing boundaries. Lower expense ratios and cost effectiveness. One of the most attractive benefits of Nasdaq 100 ETFs like QQQ is their low expense ratios. An expense ratio is the annual fee you pay to the fund manager, expressed as a percentage of your investment. These ETFs are passively managed, meaning they simply track an index rather than having a team of analysts actively picking stocks. Compare this to actively managed mutual funds, which often come with significantly higher fees. These higher fees can eat into your returns over time. For example, a Nasdaq 100 ETF might have an expense ratio below 0.20%, while an actively managed fund could easily charge 1% or more. Over decades, these savings can add up to a substantial difference in your investment returns. Investing in an ETF helps you keep more of your money working for you. Liquidity and ease of trading. Nasdaq 100 ETFs offer excellent liquidity and ease of trading. This means they behave much like individual stocks. You can buy or sell shares throughout the trading day at market prices. This flexibility is a major advantage for investors. Unlike traditional mutual funds, which are priced only once a day after the market closes, ETFs continuously trade on stock exchanges. This allows you to react quickly to market changes or adjust your investment strategy as needed. Whether you want to make a quick trade or invest for the long term, the high liquidity of these ETFs makes them very accessible. This provides investors with the freedom to manage their positions efficiently. Potential risks and considerations. While Nasdaq 100 ETFs offer exciting opportunities, it's wise to understand the potential downsides. Every investment comes with its own set of risks, and these ETFs are no exception. Knowing what these are helps you make informed decisions for your financial future. Concentration risk in technology. The Nasdaq 100 is heavily weighted toward technology and growth companies. This is great when the tech sector is booming. However, it also means your investment can be quite sensitive to downturns in this specific area. If tech stocks face headwinds, the ETF is likely to feel a larger impact compared to a more broadly diversified index. For instance, a significant portion of the ETF's value comes from a handful of very large tech companies. If these few giants stumble, the entire ETF could experience notable declines. This high concentration means you're placing a substantial bet on the continued strong performance of the technology sector. Stay tuned for part 2 where we'll look at the benefits, risks, and how to get started. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.